Length of Service Awards Program Committee meeting. It is Friday, August 27th at 9:30 a.m. We are in the Chesapeake Building in Leonardtown at the St. Mary's County Government Main Campus. With me today, I'm Rebecca Bridget, the chair. To my left is Jeanette Cudmore, CFO, Commissioner Mike Hewitt, and to my right is Mary Ann Murray, representative community member, and Catherine Pratson, HR director. Also supporting us today is Michelle Rance from Finance. Thank you very much. Jody Kwasny is on Zoom. Welcome, Jody. And Amy Carter is our videographer who is taping us for today. So thank you all for your participation. We're going to jump right in with a roll call for the approval of the August 27th, 2021 agenda. That's today's agenda. If you take a look at it, board members, please, and we'll take a motion to approve.
I'll make a motion to approve the agenda.
Is there a second?
I'll second.
There's a motion and a second to approve today's agenda. Any discussion? Hearing none. All those approved?
Aye.
Aye.
Any opposed? Motion carries. Thank you very much. Item 2B is the approval of the meeting minutes from July 22nd, 2021. If you take a minute to review, then I'll entertain a motion to approve.
I'll make a motion to approve the July 22nd, 2021 meeting minutes.
Second.
There's a motion and a second to approve the meeting minutes from July. Is there any discussion? Hearing none. All those in favor?
Aye.
Any opposed? And I am abstaining since I was not here.
I am also, because I was not here.
Okay, great. Thank you. Motion carries. Item 3, we begin with the presentation with the Q2 Investment Performance Report. Pat Wing from Marquette Associates is joining us today. Welcome, Pat. Thank you for joining us. And you can jump right in whenever you're ready.
All right, great. Well, thank you, Dr. Bridget, and it's great to see you all again. So in your packet, there are 2 books. The second quarter performance report is the thicker book, the one on top. And if you would all please hop behind section 2 where you see, exhibit 2. Exhibit 1 is just an update on Marquette. Nothing earth-shattering going on, business as usual. But so behind exhibit 2 is the market environment. And as you all know, we'll begin here on page 6 just with an overview of the economic environment, of the capital markets environment to provide context for how and why the fund performed the way it did during the quarter. So we'll start with the U.S. economy, and as we work our way through page 6 and page 7, there's really 3 main themes occurring at the moment as we see them. And the first theme to illustrate that, if you look at the top right chart there where it says U.S. real GDP growth, the bars in that chart are showing the quarterly economic growth numbers. The fully colored in bars are the actual data. And then the striped bars all the way to the right there are economist estimates moving forward for the remainder of this year and then early next year. And the orange line is just the year-over-year number, so a different frequency of the data. But the first key theme right now is that the economy is essentially what's called peak growth, if you will. If you look at those estimates, those last 4 striped bars, Q3 is the highest estimate, and then economists expect a deceleration in economic growth as we head into 2022. And the big driver behind that, if you will, I'll shift gears and look at the bottom chart, is really the fiscal policy coming out of Washington. So we're all well aware of the historic measures that have taken place over the past 12 to 15 months or so. And what this chart is showing is the fiscal policy contribution to GDP growth over time. So if it's above 0, it's been contributing to GDP growth, and below 0, detracting from it. So if you look closer to the right where you see the last fully colored in striped bars, that's the fiscal contribution amid the pandemic and subsequent to it. And you can see, again, echoing the comments that they've just been historic in terms of speed in which they were enacted and size. They were actually much higher than the financial crisis that you can see in the beginning of that chart there. But as we move forward, it's important to remember that a lot of these measures, or at least a material amount of the policy measures, are one-time sort of shots in the arm, if you will, or short-term measures, whether it be stimulus checks, expanded unemployment benefits, things of that nature. So it doesn't increase the baseline spending rate moving forward. As those measures roll off, then fiscal contribution to GDP growth will therefore decelerate and is actually set to become a headwind in 2022, which leads us really to the second key theme. So this has been a very public sector-led recovery, and we're going to need to see a strong transition now from policy support to the private sector being able to take that baton and drive economic growth moving forward. So when we think about those two key drivers, most importantly consumers, and then businesses as well. So when we think about the state of consumers right now, balance sheets are fairly strong, given stimulus measures, given the rebound in the labor market that we've seen over the past few months. However, for businesses, we're still seeing issues in the global supply chain. Businesses being able to source the inputs that they need to produce the goods and services for consumers to consume. And then related to that, a lot of businesses are still having a hard time around staffing. Given various, policy measures in place, COVID concerns, there's a ton of different factors at play here, which I'm sure you're all well aware of. But staffing is certainly an issue for businesses that we've seen over the past 6 months and continue to see right now. Now it'll be interesting to see once the expanded unemployment benefits roll off next month, if the labor force participation increases, and hopefully businesses will then be able to source employees to fill a lot of these gaps in employment that they have right now. So as we look ahead, again, the strength of the consumer seems poised to be reasonable as we head into next year, but it's kind of predicated on businesses themselves, because if consumers are ready to spend, but they have nothing to spend it on, then that could be a headwind as this transition unfolds as we head into 2022. The other key theme, if you look on page 7, there's a lot of text and data around it, so I'll just speak at a high level, is inflation. So we talked about this during the last quarter, how inflation had been coming in stronger and hotter than anticipated for the previous couple of quarters. Much of that was due to some of the supply chain issues that we've talked about, the economic reopening, some temporary factors. So importantly, the latest CPI or inflation print that we saw still came in rather high, but it was the first time in a while it was actually in line with expectations, as some of these temporary factors at least began to moderate. So that expectation right now between markets, the Federal Reserve, and consumers is expecting that to continue to unfold. In other words, for inflation to begin to come back more in line with historical averages. Now, if that does not unfold and inflation is a little structurally higher than we've seen over the past couple of decades, really, then that could have a big implication on what interest rates do, and then in turn have a big implication on the performance of asset classes, and then even the relative performance within asset classes. And I'll speak more to that in just a second. Any questions right now about the economy before we shift gears into reviewing capital markets performance?
Here's what I want to ask you. It's Patrick, right? You go by Pat or Patrick, but anyway, here's what I'm saying, Pat. Went to Mako conference, and of course these other people on this board have heard me say this, so I'll just repeat it for your benefit. And we had a great presentation by the Director of Revenue Estimates for the Comptroller. The point is that I read what you have here, yesterday and I look at several key words, as they say. Spending is set to become contractionary, or whatever that, I'm sorry, I can't pronounce it all, but you know what I mean, it's going to contract.
Yes.
Private sector is positioned to take the baton from the public sector heading forward. And in this 5 years will be higher inflation than the latter half of the decade. My point to you is what they said out there at Mako was the recovery from this 2020 COVID, and I've been someone that says we need to be cautious. It's not about me, but I just want to be cautious and conservative, because when we have these increased revenues, and that's what we're seeing big tax revenues, probably $25, $30 million over projections. That's a tough sell when people say, hey, How come you didn't fund my salary? You got the money, you didn't fund my salary. But the point was, they talked about the people who lost the jobs during the COVID were the low-income, low-wage workers, the people in hotels, the people in some retail, say, small business, those types of things, people in restaurant industry. And what was unique about that is those people got their unemployment benefits plus $600, plus $400, plus $300. They were making more take-home pay than they were making when they were working. So the incentive to move forward, when we want to talk about going from the public sector to the private sector, is how we incentivize these people to come back. And what this fellow said out there in Ocean City was, what you're seeing is, and it's happening with our sheriff's department, it's happening everywhere, these signing bonuses. You know, we'll give you $3,500. Where I'm going with all this is his point was, we will probably see a precipitous drop-off in economic growth in the latter part of 22 into 23, 24. Sounds like what I read here yesterday is it's consistent. The next thing I get to say, though, is we've just pumped $3.2 million into this thing. So I know you have a little bit more, and I'm going to let you go, but I just want you to know, from my perspective, I'm not speaking for the board, I think we still need, what they said out there was, instead of getting into reoccurring cost, that you get into pay-go, pay for your CIP projects, cash if you can. What they said was, invest in your retirement plans, invest in your OPEB. Now, we got those things I like to think we got them kind of covered. We've been focused on them. Third thing they said is increase your fund balances. Increase your rainy day fund. These are things I think St. Mary's County's been doing. But my point to you is we need to make sure we keep these funds, these things that we do, in my opinion, a conservative approach. Now, I think we'll probably be good as far as return on investment for the next, again, like the guy said, 18 to 24 months. But I just hope that you keep an eye on, don't lose our money.
Well, that was a lot to take in, and what my comments related to that, I think our outlook compared to what it sounds like you heard at the conference, Commissioner, is largely in line with that. As we look forward, I don't think out of consensus to view the economy as set to decelerate based on what I discussed and what you laid out there. And as we think about, moving forward, and the fact that the county just put in a lot of money into the trust, and what we'll show shortly when we look at the rebalancing review of what happened subsequent to that contribution, we had previously had an overweight to equity markets and underweight to fixed income, and that's been helpful so far. But given the large portion of money that went into the trust, we just put the assets in line with their respective targets. So as the new money came in, marginally, it was more conservative after the rebalancing. To your point, I think there is a lot of uncertainty, certainly as we look out 2 to 3 years, and it's hard to predict, obviously, what's going to happen in 2 to 3 years' time. We have much more visibility over the next 10 to 12 to 14 months. And as we look forward, are there, marginal changes that may be appropriate to, keep things in line with that assumed rate of return of what we're trying to hit over the long term, but at the same time protect the funds, given more money is being pumped in over time as we try to grow into this better healthy funded status. So if the money's going to be coming in, let's be more thoughtful and more conservative about how it's invested, given the uncertainty over the next 2 and 3 years for both funds.
All right, I think I made my point.
Okay. So please, let's shift gears to page 8 here, or excuse me, page 9. Page 8 just talks about the global economy, but I'll weave in some comments around that when we look at performance. So on page 9 on the right-hand chart, these are showing major asset class returns across equities, fixed income, and some inflationary and sensitive assets. But if you look at the first top 3 rows there, where you see U.S., international, and emerging market equities, those gray bars are the Q2 numbers, so very strong returns from equity markets. U.S. equities up north of 8%, so investors really continuing to price in, at least in the near term, the further economic recovery. Related to that, corporate earnings have been exceptionally strong at the same time, coming in well above analysts' expectations, so that has also supported stock prices. But when you look at international emerging market equities, they posted decent gains, but they lagged their U.S. counterparts a bit. And we believe the reason behind that is related to their respective economies, namely the relative lack of a successful vaccine rollout, economic reopening, at least compared to the U.S. And investors are well attuned to that and certainly weighed on investor sentiment. So again, these stocks made money, but they didn't keep pace with U.S. market given those concerns outside for those outside economies. If you look at fixed income, starting with U.S. bonds, there was a really interesting quarter for fixed income, pretty much the mirror image that we saw in Q1, where interest rates rose, putting downward pressure on bond prices. We actually saw interest rates come down a little bit. So U.S. bonds, they're up almost about 2%. And then below there, high yield bonds, which are riskier type bonds issued by more speculative companies. They carry a little bit more credit risk, outperforming the safer U.S. bonds because of how well equities did. So when equities do well, riskier bonds tend to do well in sympathy with that, and that's exactly what we saw. And for the fund itself, and we'll see the returns here in just a minute, we had an overweight to equities during the quarter and an underweight to fixed income. And then within fixed income, an underweight to these U.S. bonds and a little bit of an overweight to high yield. And given the relative performance of those asset classes, it was helpful for the fund relative to the benchmark. So to wrap up quickly on page 10 before we get into the results themselves here, just taking a look under the hood in the U.S. equity market quickly, a lot of this data isn't necessarily relevant for the LOSAT because it uses all index funds, but what is relevant, if you look at that second bullet point in the middle there, we note how large cap stocks did better than small and mid-cap stocks during the quarter, and that was also a reversal of what we saw in Q1. So if you recall, small and mid-cap stocks did very well in Q1, and that was helpful for the fund on a relative perspective because there was more investments in small and mid-cap stocks relative to large. So that flipped on its head in Q2, where the leadership really came from the larger cap companies, and given we had a little bit more in small and mid-cap stocks relative to the benchmark, that was a little bit of a headwind from a relative return perspective compared to the benchmark. So with all that said, let me pause here quickly to see if there are any other comments or questions for the market environment before we jump into the fund results.
Yeah, me again. This thing about fixed income with these 10-year treasuries getting murdered. You know, I've never seen them. I saw it recently. It was $1.26, and you know that just downward trend. But what I don't understand is the Fed policy, and what I'm hearing is they're going to ease the easy money policies. So if the Fed were to raise these things from zero or whatever, I mean, they got to do it at some point in time. You have to think that 10-year treasury is going to go up. So what's your sense of, you guys keep better track of the Fed than I do, but what's your sense of interest rates?
So we would concur with your statement there. The Fed, they actually have a big meeting today, their annual Jackson Hole Summit. Actually, the chairman is about 10 minutes away from giving the keynote speech, where there's a little uncertainty around what he's going to lay out. So the first thing that they're likely going to do is what's called tapering their bond purchases. So right now they're buying $80 billion of treasuries a month, $40 billion of mortgage-backed securities a month to support those markets to keep rates low and try to stimulate demand. So their first step in reversing some of the stimulus is going to be to scale back some of those bond purchases. So in isolation, when we think about that, you have less demand coming from the Fed for treasury bonds, and then perhaps an increasing supply if we get some of this infrastructure legislation ends up being passed. Then a huge increased supply, less demand, just basic economics would tell you that, you know, all else equal, that could lead to upward pressure on rates. So as they began to think about, you know, tapering and then eventually raising short-term interest rates, we certainly think that the risk reward, given how low rates are, is skewed to the upside moving forward.
I guess my thought is, though, is interest rates could rise, or at least the perception is they could rise. People tend to like to be ahead of that curve. So I think rising rates probably negatively impact our portfolio. Would you agree or disagree?
The fixed income part of the portfolio, absolutely. If it's an orderly increase in rates, then it may not have a big impact on the equity side. But if it was a little bit more of a chaotic increase in rates, like we saw in 2013, when the Fed did a similar exercise of scaling back their bond purchases, rates jumped very, very quickly, and the markets came under pressure in response to that almost immediately. But given the Fed has already done that once before, it's the hope that the market now expects what might happen when they start to scale back. So for fixed income, yes. For the rest of the portfolio, it's a little uncertain, I would say.
All right, here's a hard question. Delta variant, if I hear COVID one more time, I'll flip out. But I guess my point is, with this big increase we're seeing now, and who knows if that Delta will mutate into the, whoever else it can be. What's the thought on economic recovery, economic growth, given this current big uptick?
So right now, I think we're all seeing it, right? Increased mask mandates, more social distancing. You see in the school districts as far as requiring students to wear masks. And, we can look at the impact of that based on what happened previously, right? We would expect, lower consumer activity. At the same time, we may see on the back end more policy support, right?
Geez, how much more they got? They got to be bankrupt, they're $25 billion down now?
They haven't gone bankrupt yet. So
Well, no, I know, I'm exaggerating. My point is that they used to say the debt was costing us $500 billion. It might creep up to $1 trillion. Now, that's a big hit on, GDP.
Yeah, it's certainly, so right now it's really interesting that the outstanding debt has never been greater. But since interest rates are so low, the expense...
It's still got to be paid back.
But the expense paid on the debt is very, very low. But when rates go up and interest rates or interest expense takes up a larger portion of the federal budget, then that just means there are less productive uses for spending, right? There's nothing as less productive as just paying interest, right? And then, the budget is not infinitely large, despite, the large numbers being thrown around.
If you're going to borrow money, have something that it returns on that investment higher than what you costing you to borrow it. Now, granted, I never agree with people say, hey, now's the right time to borrow because interest rates are so low. The key gets to be, what are you going to do if you get it?
The money, yep.
Yeah, and now if you get an idea that's higher than the low interest rate, good. But I still think that, we got money coming out of a fire hose, and it's just hard for us to, we throw money in anything. We got it, we'll throw it at you.
Right. That's exactly what has happened. And if the Delta variant leads to, further shutdowns and quarantines, I wouldn't rule out more of that happening for the fiscal authorities, again, to try and offset some of that impact. Now, eventually, it's got to subside at some point, but in the short term, it doesn't seem like there's, say, the will necessarily to just, let the private sector deal with shutdowns, deal with closing when they're enforced by, the federal authorities and local and state authorities. I think they realize that if they're going to move forward with that, then at least some level of aid, of help for individuals and consumers is warranted.
Okay, I'm done.
So with that, if we hop behind Exhibit 3, we'll get into the results for the fund itself. So on page 16, just some high-level observations, and then we'll run through the data behind run through the data behind the text here. But at the top, you see the market value at the end of June was $6.2 million, so this obviously isn't reflective of the contribution. We have an updated value that we'll show you in the next book. And then you can see the investment gain there of $311,000, and the fund returned 5.3% net of fees, slightly ahead of that policy benchmark of 5.2. So when you look at the bullets below that where it says attribution, that's really just attempting to explain the difference between the fund return and the benchmark return. So on the positive side, what was helpful, again, having a little bit more money in equities than the target. And since equities did quite well, that was positive. On the negative side, as I mentioned, was the U.S. equity structure. So the managers themselves are all index funds, but how you put the pieces together relative to the benchmark is important. And again, there was a little bit more money in small and mid-cap stocks, which didn't do as well as large-cap stocks. So that was a little bit of a headwind. So if we shift gears here to page 17 and give you some of the data behind those observations at the top, you see the summary of cash flows here. We start in that first column, the second quarter. You can see we began at about $5.9 million. There's a slight outflow for expenses and fees, and then the net investment changed there. So all put together, the fund grew by about a little north of $300,000 during the quarter. If you look a little further to the right, skip the year-to-date, that's calendar year, and then focus on fiscal year, obviously most important here. We began the current fiscal year, $4.1 million. There was an earlier contribution of $1 million. You can see a little bit of a withdrawal there again for fees and expenses, but then a net cash flow of about $975,000. So all told, the fund grew by about $2.05 million in the current fiscal year. And if you look at the returns in the middle of the page, you can see the Q2 return all the way to the left that I mentioned a second ago. Year to date, the fund has now returned 8.3% versus the benchmark of 7.7. And then fiscal year to date, you see 22.4 versus 23.2. So you can see for the fiscal year, obviously, we have the second half of last year and the first half of this year. So the first half of this year has been relatively positive, recouping some of the underperformance from the second half of last year. But most importantly, that 22.4% well ahead of the assumed rate of return, right? So all else equal when the actuarial valuation comes out, and it never is equal. But if nothing else changed, then we would expect to see an improvement in the health and the funded status of the LoSAP. And then finally, on the bottom page here, it's just showing asset allocation versus policy. Again, this is dated. We'll show you the update, the rebalancing review, and an updated number as about a week ago in just a few short minutes. So if you look on page 18, quickly, just a review of the cash flows during the quarter in that bottom table. If you look at the second column there, the net cash flow, you can see most are negative as you work your way up and down the page. Where things are positive, number one, in that Schwab US Large Cap ETF. In April, we had recommended moving some money out of small caps. There you see the negative 50,000 and change number, moving about 50,000 from small into large caps. So we did have less of a small and mid cap overweight during the quarter than we had in Q1, so that helped relative performance to some degree. When you see a lot of the other negative numbers, that's just because these are ETFs. They don't reinvest dividends. They throw them back into cash. There's no option for an ETF to reinvest like a mutual fund. And the other positive number there, really third up from the bottom, $20,000 plus positive into high yield as we use some of the existing cash that had been built up during the second quarter and move some of those funds into the high yield market. So if you want to skip ahead a little bit, page 19 is just a breakdown of asset allocation. But if we could skip to page 20 to show you the results of the fund relative to other public defined benefit funds out there. So just quickly as background, we use a third-party platform to put these reports together. About 50 other firms like ours use it, and there's trillions of dollars of plan assets on the platform, really giving you an opportunity to slice and dice the data on an anonymized basis to compare how the fund is doing to peers. So there's a lot going on this page. If you would just focus on the bottom two rows at the table below where you see the circle and the triangle, and then work your way from left to right, you can see the 5.3 and the 5.2 there for the quarter. So the 5.3% return was good for essentially in line with the median, which is the 50 in percentile right there, or excuse me, in parentheses right there. As you work your way from left to right, you can see the 8.3% was a little below the median. And it's a similar story as you work your way from left to right. So echoing back to, or circling back to your comments, Commissioner, you know, the fund has been conservatively invested over time, and it's really indicative of the rankings here because
This 90 and 84, 64, 79, I mean, when I see that, I'm not impressed. My point is that you're saying that because we have this conservative investment,
Yeah.
our returns are ranking lower than what could be out there. Now,
Exactly.
someone may say you guys are too conservative, and people have said that about me. And the point is that anytime you go a little higher in the ranking, you have a little bit more exposure, right?
Exactly. So it's just important to be cognizant of that the fund has been invested much more conservatively. It has a much lower assumed rate of return. A lot of the funds in this universe are probably 7.25, so they are a little bit more aggressive. So you take these numbers with somewhat of a grain of salt, but, most of us as humans want to know how we're doing
We
relative.
want to be number one.
Yours are number one. Exactly. But, markets have done so well. You see that, really since the inception of the trust all the way to the right there, the benchmark up 10% annualized over that time period. So a very, very strong market. So given the funds more conservatively invested, those rankings aren't particularly surprising.
But am I correct in saying that by being conservative, we're less susceptible to a correction?
Oh, absolutely, without a doubt.
Yeah.
So when that does unfold, then we'll see the opposite. We'll see the mirror image.
I mean, I'm not saying Chicken Little here, that the sky's falling, but I'm still saying we've gotten to this point, let's figure out a way to stay here instead of keep taking the risk. It's like
Right.
going to the casino and say, I'm on a roll, let's keep it going. And
Right.
the longer you play, the more shots they have at you going down.
Yeah, the house rules in that situation, absolutely. But I think if you recall our asset allocation discussion from the last meeting, the ultimate outcome was to still stay very, very conservative with the fund itself. Marginally increase equities, but not to a great extent whatsoever, and keep the fixed income relatively conservative as well.
I would say to my other board members sitting here is that I think what we need to do is be comfortable where we are, and I'm not trying, I talk too much, but my point is everybody else comfortable?
Yeah,
Yes.
we agree. We're putting money into it. We don't want to lose it. We totally agree. We
So-
still have to have some conservative.
But if I were to say to you, we had a 22.4% return, but that was number 90 out of 100 or something like that, you say, geez, Mike, lost a lot of money with that conservative return.
Right.
I don't know if you lost it,
Well, we didn't lose it, but we
Sometimes you
we
get to
lost
keep
the
it.
exposure.
but
Yeah,
I think that's the point, right?
we want to keep it.
Right.
Yes.
Yeah. There's
So
a
there's
middle
a-
ground.
Yeah.
It's a balance.
It is.
It's a balance.
Yeah. And it just so happens, it could have been, very easily the opposite, right? It
Right.
just so happened that the past 3 years have been very, very favorable, but for the next 3 years, obviously, there's no crystal ball, so that's the key thing, you can't predict, but you can be prepared.
Right.
Right, and the latter is the most important. You can't control the former, you can control the latter. So we need to keep that at the forefront of our thought process as we continue to move forward here. Okay, so just quickly on page 23, and then we'll wrap up with just a quick look at the fees. Not too much to comment on this page. Again, this is a breakdown of the total fund again up top. So those are the returns we showed a minute ago. But I just wanted to highlight or illustrate the comments I made around U.S. equities. So you can see the U.S. equity composite up 7.7%. A little bit behind the benchmark. Again, the composite is just a weighted average of the 3 index fund returns. And since they're index funds and they'll be matching the benchmark, it's how the pieces fit together, right? Do we have more in large or small cap stocks relative to that policy? And since there were a little bit more in small cap stocks, which didn't do as well, that will explain that slight underperformance. As far as the rest of the investments, there's basically only one manager in each of the asset class, and they're all passive, so they'll be tracking them to a T over time. So with that said, just quickly on page 26, I wanted to make a couple of quick comments as it relates to the fees. Importantly, like we've talked about before, since the fund is on the lower end, keeping fees low is of utmost importance to allow that fund to compound and grow over time. So you can see in the blue bar there, all the way at the bottom, we're just talking about 6 basis points, so very, very low fees for the fund, given it's all passive. To circle back to some comments I made probably about a few meetings ago about when to think about perhaps some active managers, probably more in the $12 to $15 million range. And the first area really that we would suggest to look at is probably in fixed income, because active fixed income is cheaper than active equities. And also the majority of active fixed income managers over time tend to outperform the benchmark. So it's an area that you have a higher probability of picking somebody that can outperform, and the relative fees are much lower. But I think that's, again, a conversation as we proceed, as the fund continues to grow. But I just want to mention one other quick thing. There was discussion at yesterday's meeting, if we could add, for further disclosure and transparency, our fee and the custodian fee to this page, and I'm happy to do that if the committee would like to see that additional information moving forward.
Yes. I'm just one guy, but
Yes,
No,
I
We agree.
you don't want to
I
do it?
think you have consensus on the board.
Sorry. I knew I
Thank
would.
you.
I already made the note.
SORP board agreed to do that
Right,
yesterday.
right.
so that's good.
Okay.
Right.
But again, you're on a fixed rate, you're not on a percentage.
Correct.
Right.
Yes, that's correct.
It works for me.
But it's a fixed rate across all the three funds, so there can be some changes.
I get it, but you're not getting a point here or a
No,
point
no,
and a
no,
half
no.
there. Yeah, yeah.
No. But for the individual funds, it may change over
I got
time.
it.
Yep.
Right, because it's proportional by the
Exactly.
assets, right?
Exactly.
Right.
So with all that said, let me pause here. That wraps up my comments for the fund here itself before we shift gears, but happy to answer any other additional questions or address comments from the committee.
I've asked mine.
Have any go?
If there, oh, go ahead, Marianne.
So these returns, are they indicative also that the fund had holding so much cash in the beginning?
That didn't have a big impact. So the cash level is usually around $25,000 in sort of a base case scenario. You know, we want to keep some liquidity as fees and expenses come due. So at $20,000, we're just talking about maybe 0.25% of the total fund. Now, it does build up over the quarter as dividends are being paid. It can increase to maybe $50,000 or $60,000, but still isn't a huge portion of the fund. And when we think about having an overweight to cash, since the target's zero, we think that as synonymous with sort of, broader fixed income. So in unison together, we can think about the split that way. So a long-winded answer to a short answer of no.
Okay, thanks.
If there are no other questions from the board, we'll entertain a motion to accept the QT investment report.
So moved.
Is there a second?
Second.
Any discussion? Hearing none, all those in favor?
Aye.
Aye.
Any opposed? Motion carries. Thank you. And item 3B is the asset value update.
Yes, thank you, Dr. Bridget. So this is in the second packet, the smaller packet. When you get a chance to open that book, if you can hop behind Exhibit 1 there, we'll talk about the asset value update. So this is on page 4, starting with a rebalancing review just quickly, and then we'll get into the recent value. So again, on page 4, this is our typical rebalance sheet here where we're showing the allocations across the funds, their allocations, asset class allocations. We take a look in the total assets column, really the second from the left there, and work your way all the way down to the bottom. You can see that huge cash amount of $3.22 million. So there was a contribution of $3.2 million
3.2.
flat, correct? In probably the middle to the latter half of July, I believe.
Yes.
So we work with Ms. Cudmore and staff. They let us know when the money had come in, and you can see what that did to the asset allocation in that bottom left table here. So if you look at the differences, anytime you see anything in red, it's indicative of an underweight, and you can see cash all the way at the bottom of an overweight, a huge overweight, since it was about almost 50% of the preceding value of the fund coming in as cash. So in column, the rebalancing column, a couple over from the total assets, you can see the rebalancings that were made. So outside of U.S. equities, I'll circle back to that just a second, taking off that equity overweight that we've had in Q1 and Q2, that's been helpful as the economy sort of begins to decelerate, taking a more risk-neutral type of approach. So everything was pretty much taken back to its target. The one key difference, if you look at U.S. equities, you see large caps up there and mid caps. There was no money added to small caps. It was really mid and large caps. Again, further kind of mitigating that small and mid cap tilt as the economy begins to decelerate. History would suggest, larger companies, safer, more conservative type investments tend to outperform. So we thought it'd be prudent to add most of that money to the large cap area as opposed to, kind of doubling down on that small cap overweight. And then the outcome of that is in the bottom right table, and you look at the differences all the way to the right, it's pretty much zero there across the board, taking everything back to target, holding a little bit of cash for fees and expenses. And as I mentioned a minute ago, that overweight is sourced from an underweight to investment grade. Again, they're somewhat synonymous asset classes.
You expect any calls or anything to impact any of this? We have
Calls?
I know the 25,000 or 20,000. The cash is low now, and I'm fine with that. But I guess, are we positioned such that if we get someone having a call, that we can get the money from somewhere?
Well, there are no calls.
With this group?
With this group, yes. That would just be relevant for the OPEB funds.
All right, sorry, mixing apples and oranges.
Yes, so any cash would just be for fees and expenses, and we have pretty good clarity on.
I've been working the Hollywood Carnival at night.
So if you could please skip to the next page, page 5. So the rebalancing review, you can actually see the market values were as of the end of July, so that's when it took place. And now these are updated values as of about a week ago. So the total assets up top at about $9.4 million, basically unchanged since the rebalancing, as markets were pretty flat during that time period. We've seen some appreciation over the past week. That number may be closer to 9.5 as we stand here today. But if you look at the bottom left table again, when we look at the asset allocation versus the targets, pretty much no change since we made the initial rebalancing or executed it about 3 weeks ago. So there are no recommendations right now for the committee to consider as it relates to rebalancing, because we're pretty much spot on all targets. So questions, comments from the committee around the rebalancing review and asset value update?
No.
Great.
So you think we're around 9.5 million now? 9.4 it says here, you think it's?
9.4, that was a week ago. The market's up
Yeah, I know.
decently since
I
then.
know.
I think a 9.5 is probably, of course, a reasonable estimate as we sit here
I
today.
think, and our target again was 17. I know that can bounce around too, and sometimes that's a moving target. So, all right.
And we're going to have the valuation, we're just
We
talking
have to
about-
work on that, yes. The last, the liability at June 30, 2020 was 19.8. So we have to work on that, but we just infused this cash. So
Again,
the next.
we're at 50%. Wasn't long ago, we were a lot lower.
Great.
Right, we're doing a great job, and I think, with the money that was put in there, the additional 3.2, we have an actuarial that'll be, needed to be done this year for the 2023 budget.
right.
That'll happen after we get through the audit
Well,
process.
consistent with what they were saying out there at Mako, and I think we're going to have a fund balance pretty healthy this year, and we may take some heat for that. But I would say we're not going to be borrowing next year, and that's,
We're not borrowing this year, in 2022.
Oh, okay, whatever year.
I know.
I know. So,
But,
but my point to you is this: I know we
Hey, go.
need some of this fund balance to protect us from having to borrow.
Correct. We'll also need it for the bond authority, the difference that we would need for the 23 budget.
Right. So again,
So-
we bring up the rainy day fund. It's all these things we've been talking about.
Right.
But what would be
Hey, go.
important to know is, what do we have that's, the discussion or whatever we had was turf fields for high schools last year. And the point was, some commissioners wanted to put more into the OPEB than we did. Other commissioners wanted to spend it on turf fields, and that's fine. But would it be healthy to know what that delta is available to us, so that when someone says, I think 3 million's a good number, and someone says, well, wait a minute now, because we were criticized for not doing our arithmetic. And I'd like to think we can do our arithmetic.
And we calculate that as part of the budget process on where we maintain that 15% from revenue to reserves. And that's how it told us last year that we could do $11 million to maintain.
I'm
And
sorry
we-
to interrupt you, but the thing about the 15%, we've been consistently above it.
Right.
We've been in the low 20s.
Right, right.
And that 5% delta is something that we're not being able to return, to either return it in a tax rebate or a tax refund, which doesn't seem to be much political will to do, or return it in an amenity
Right.
of some type.
Right. But we used it to maintain the 15. Yes, we were above, around 20.
I think we're going to be higher than that this time.
We're going to be higher, probably. We'll have to wait for the audit to come back through, but yes, we try to stay at the 15%.
I think projections we're seeing,
And we used every bit of it for the '22 budget, the 10 million, almost 11 million, what we said to maintain for the '23 budget as pay-go and non-recurring items. So,
we're off base, I'm sorry.
but I understand, we'll do that exercise again to determine how much will be available.
Let's
in
just
that-
try to be pretty close to what we thought we were.
Yes.
Good. And I think that wraps up our asset value update. Any other questions or comments from the board? Otherwise, we'll go right into the investment policy statement review. Pat?
Okay, great. Thank you, Dr. Bridget. So this begins on page 7, and for those of you who were here at the last meeting, if you recall, we did a comparison of the existing statement versus the initial draft, and the key, our key philosophy around building the investment policy statement, you see it in the first bullet point up top, but it's really building a roadmap, right? You got to answer key questions. What are you trying to do? Why? How? And who's responsible for what? And we feel those are all addressed by, you see these sub-bullet points at the bottom here of what the IPS should cover. So if I can back up for a second, I think the plan was for the committee to review the statement and come back with any comments or suggestions, recognizing the fact that some of the committee wasn't at the last meeting. Let me just pause here for a second to see if maybe we should extend that timeline a little bit.
I agree.
Yeah, okay. And
Thank
so
you.
I have included another draft in the book itself for review. And just to circle back on, again, yesterday's discussion, there were a couple comments and suggestions. One being adding some definitions, say, to an appendix, which we're happy to do. We don't really want it in the body of the text itself.
Wait, back up for a second. Who was in your yesterday discussions?
The SORP,
The
we're
SORP.
doing the
SORP,
same.
okay.
Oh, I
yeah.
apologize, Commissioner.
No, look, I apologize. I missed that one. I had something going on.
Right. So
But I'm not on that board, so I don't have any input in it.
What the SORP board requested, specifically Mr. Walters, is perhaps adding some definitions in an appendix, so not in the body of the text, to leave that real clear and concise, answering these questions, but some definitions in an appendix may be helpful for existing trustees or maybe even a new trustee coming on to the committee, so happy to do that. The other,
Let me back up.
oh, yes, sure.
Can we, I know SORP meets before ours. It used to be, we used to do LoSAP, OPEB, SORP. I thought we did in the same day, but maybe I'm wrong. My point would be, can you provide the minutes of a SORP? Is that public information, minutes of SORP meeting?
It isn't, because it just happened yesterday, so they haven't been approved until the next meeting, like ours are, for draft, so we'd have to review the video.
Maybe you
and
can
they-
just send out to the commissioners that the meeting was held, and if we want to view it on YouTube.
Okay, sure.
Because we
Yeah,
can't.
we
Yeah,
can
the
attach.
YouTube's out
I mean,
there.
I'd like to be able to know what you're referencing when you said discussion yesterday.
Yeah.
Right.
And is there any opportunity for a red line version of the text, or is it really just so raw and new that this is just a new document?
It's a new document,
Okay.
Dr. Bridget. It's a red line version, I think, would be incredibly difficult to
Okay.
really discern the
But
changes.
also, what you presented last month, Pat has the existing document and highlighted areas where this new one is different.
Right.
So if you
Oh,
were
that
to
may be helpful.
That'd be helpful. So I'd be happy to do
One's
that.
attachments.
Thank you,
I'd be-
okay.
See that.
I'd be happy to cover that again at the next meeting, if that would be helpful.
Is that, I didn't want other folks to repeat, I can look back, but it's okay, I guess, to include those materials for anyone that's interested.
Right.
To review them again. Okay, thank you.
And just to circle back, Commissioner Hewitt, the policy statement for SORP, what we were talking about yesterday is a definition of the different types of assets.
Right.
So for a new board member who might not know, so these are different types of fixed assets, these are different type of equities, and that's what the reference was for the definition page. So for potentially a new board member, it would help them come up to speed.
Well, tell me, are those similar to what we're looking at now? Is
this
SORP
plan-
similar to this?
Not to the length of service plan, because this is just
No.
a passive investments. It's much more similar to the OPEB
Okay, apples and oranges, okay. Gotcha.
Yeah.
Right.
Yeah.
But from a structure perspective, we could certainly add some of the relevant, investment definitions for each respective fund, right? We will customize everything based upon the investment strategy. So the appendix definition for LoSAP would be much shorter in length than for the other two funds, which have much more diversification. But that was one comment made, and then the second comment was around prohibited activity, the suggestion being,
Commodities.
Commodities.
commodities is already in there. It was actually around cannabis
Yeah.
companies, cryptocurrency.
Right, cryptocurrency, that there would be, the plan would be prohibited from purchasing
doing
those
it.
things
And-
directly.
Right, and then direct foreign exchange transactions, all of which I think are reasonable. But those were the two main comments, at least to come out of yesterday, as far as the definitions and adding some prohibited investment. So the plan for that board was for everybody to review the current document, sort of funnel comments to Ms. Pratt, I believe, right?
Yep.
And then we would circle back up at the next meeting and just review a compilation of that feedback to have that broader discussion amongst the entire board. So I think for our next meeting, what we can do is do the comparison versus the new draft, and then similar to the SORP, if the committee has any other suggestions or comments, maybe funnel them to one. I'm sorry.
To Jody.
To Jody, right, and then we can have that discussion at the next meeting. So again, this is a process, right? We want to do it thoughtfully over time. It's nothing that has to happen tomorrow, next meeting, 2 meetings. So let's just be thoughtful about it and get it to a place where everybody's comfortable.
Right.
Okay?
Great, thank you. Appreciate the suggestions. Any other comments on the investment policy statement?
No.
Okay, next is next steps.
Yes. Okay, so to wrap up that discussion behind the next exhibit, just quickly, on page 9. So under next meeting, it does say investment policy finalized. That was way too aggressive assumption on my part, so I apologize. It would be more, again, of a continued discussion. But then related to that, as we've done in the past, we'll make any recommendations based on the fund's existing values, respective overweights, underweights, as we've done in the past. And then really get the ball rolling around the custody RFP process. So just as a brief overview, that ball has started rolling. We have representatives really across the various boards and departments, and a timeline set out. And with that, I'll pass it over to Ms. Pratt for a little bit more of a detailed overview.
Thank you, Pat. We've been working with procurement, and Pat and I, to plan a custodial RFP. We discussed it last month with the board, and the board approved moving forward in that direction. And Mary Ann has graciously agreed to be
Thank
on the
you.
technical evaluation committee. And then the citizen member, John Walters, has agreed to be on the evaluation committee as a representative from SORP as well. Pat will lead the committee, I am on the committee, and then Joy Sapp, who is the accounting officer, will be on the committee, and she's intimately involved in the county's banking services currently with all of the accounts receivable.
Who's that person?
Joy Sapp.
Joy Sapp, our
She
accounting
works in
officer.
finance.
Okay.
Yeah, and she supervises all of the accounts receivable, all of the accounts payable, the payroll. So she is, again, intimately involved in our current banking, and we thought would be a strong addition.
Now, did we are you talking SORP?
Well, this is a consolidated
Right.
plan.
So we are involved. I do have a role in this somehow. I know I have no role in SORP, so I don't want to get involved in that.
Yeah, so you may recall, we went through the RFP for an investment advisor for the
Yeah,
three
yeah.
plans, and now we feel the next step is for a custodial, or a custodian for the 3 plans.
Okay, where I go with that is that I would hope that what we do is look at local banks, i.e. Community Bank, maybe even West Banco, even though they're not really that local anymore, versus the J.P. Morgans, these big, I hate to use the term New York because that sounds negative, but these bigger institutions. I know that I was surprised recently that West Banco was able to get the $30 million, some big multi-million dollar bond bill out of Metcom to support theirs. and they were the lowest bidder. I've also know that the Board of Education recently switched away from, I don't know who they were with, to Community Bank. And the thought was is they would save hundreds of thousands of dollars in fees. Point is, with government, we tend to be glacial in our ability to move. And not that I'm saying we need to be nimble, we don't. But I believe that what we need to do is be able to recognize when we can save, savings are identified, or at least we can reach out and find those better returns, or not returns, but better, lower cost, that's the key. That we're able in a position to, move on that. And so if there's anything that keeps us from moving on that, other than our own, paradigms of regress, of slowing down, that we take advantage of that when it can.
Well, thank you. And I think that was the idea of consolidating the assets from the three funds, because with that large dollar amount, we may be able to save some money. We certainly will let because our community bank is our partner, we certainly will let people know when the RFP is posted. It's going to go out on the Maryland Marketplace, so it will be public. I'm a little concerned, and I just am not familiar with how their structure, but with the SORT plan, we are paying benefits, so I don't know that they have the infrastructure to do that, because that's going to be part of the
Part of the plan, yeah.
necessary evaluation, that the banks are going to have to be required to do that for us.
Right. We'll clearly outline in the scope of services. So when the whatever bank, downloads the RFP and decides whether or not it's appropriate for them to participate in the bidding process, it'll be very, very clear what the scope of services are, what they require, and then based on the questions being answered, the technical evaluation committee should be able to get a good handle on whether or not to be able to fulfill every one of those duties. But in addition to the local community banks, if you recall, we reached out to Wells Fargo and a couple of other banks, one being Wilmington Trust, who is probably is the custodian for the vast majority of Maryland counties out there, so I fully expect them to participate. And we also plan to reach out to some other regional banks as well, because if we can get more responses, typically competition breeds pressure on fees.
Yes,
which is what we're hoping for. So
I was out there at Mako again, and keep bringing that up, but my wife and I went out to dinner. We don't like to go to those things by Care First and whoever has the best crab cakes.
Did you go to the Crab Fest?
No. I'm talking out of Mecca. No, I don't. We don't go to Crab Fest. I don't like picking crabs. Anyway, point is that we go to a restaurant. It's called Liquid Assets. Another one called Our Harvest. And the guy sitting next to me, hey, look, we don't know him. He don't know me. And he's with his wife. I'm with my wife. And it's kind of like, oh, what do you do? Oh, yeah, does that. Anyway, his whole point was, he has something to do with some kind of group that does similar. I can't even, he gave me his card. I don't remember his name. His name was Doug, but I don't remember the group that he had. But his point was, and we talked for about half an hour, was that I talked about rates we were getting. And he said, look, the problem with you small counties, or with counties in Maryland, he says, we can't get to you. I told him about we did $30 million for $1.62 or $1.68 in the last bond market. He said, man, you should have been under $1. I said, look, come on, man. Everybody's got that better deal. But his point was, you're insulated from getting to us small and nimble kind of people who can do just as good a job as these bigger banks can do, or these bigger places can do. So, well, it was over dinner. He had, he was going to look up my bio. I'm sure he's bored with that. But the key is like, he wants to reach out. And my thinking being is we need to be able to go with smaller, because sometimes smaller is more nimble, whereas bigger is more institutional.
You'd certainly,
Yeah, and we encourage anybody to register with the eMaryland Marketplace. So when these opportunities are out and advertised, they can receive it.
I didn't know about that email.
Yes, the states, that's where we post our,
And we notify all our vendors, as Pat mentioned, as
make
Jeanette
sure they're
mentioned.
registered.
Yep.
All right, I may dig up that card just for the hell.
And the intention, just a rough outline, the intention is to try to have this posted on the marketplace by the end of October.
Right.
With
Okay.
the idea that we would go through the evaluation around the holidays, and then we would have a recommendation for the commissioners, sometime in the first quarter with the transition in the second quarter.
Like a guy like me, and it's not me personally, but someone who sits in a position like this, an elected official, does not like being somewhere where someone's saying, hey, look, you're not as smart as you could be. And that's, when it's all fiduciary stuff, it's all about fees.
Right. And this should be a little less complex than the investment manager, because it is a commodity. It's all about what kind of services you can provide, what your references say, are you doing what you say you're doing, and then what your fees are. So it should be a little less complex.
Great, thank you. Good discussion. Anything else, Pat, for us?
No, thank you, Dr. Bridget.
You're welcome. Anything else for Pat?
No.
For Marquette?
Thank you.
Thank you.
Okay, thank you very much, appreciate it. Then we'll move in to item 4, committee reports, Plan Administrators Report. Jody, that's all you.
Thank you, Dr. Bridget. Well, we have 2 items on the Plan Administrator Report, and the first item is the expenses, the transfer of funds from the fund for the services. We had one transfer to Marquette Associates for $1,444.55. The second item is our future calendar dates, and we have one date left for the calendar year, which is December 3rd, 2021. And our next meeting, our December meeting, we'll talk about proposed calendar dates for 2022.
Great, thank you, Jody. Any questions on the administrator report? If not, we'll entertain a motion to approve.
I'll make a motion to approve the administrator's report for August 27, 2021.
Is there a second?
I'll second.
Any discussion? All-
May I
Oh,
add something? Thank you. Pat and I had a discussion yesterday. I don't know if the board is interested in continuing to meet more frequently next year as we have this year. You may recall that we've added some special meetings and met more than quarterly, which is the traditional calendar.
Well, let's talk about the benefits and, meeting more often versus less. Well, going back to our original quarterly versus what we're doing. So, Pat, the question in my mind would be, what is the strengths, or what is the, weaknesses of meeting more regularly? My thinking is that, are we able to make decisions that could impact something going in the wrong direction sooner?
So there's, there's a couple sides to the coin. Obviously, more frequent meetings are more meetings, right? More use of everybody's time. But one of the big drawbacks of meeting relatively infrequently, it's what's called the implementation lag, if you will. So if we're meeting today, August 27th, if we kept this schedule, we're not meeting again for more than 3 months. And as what we all saw happen in Q1 last year, markets are moving very rapidly, very quickly these days. So I don't know that, we've been meeting almost every month. I don't think that's necessary to any degree, but I think it warrants consideration perhaps.
Maybe every 6 weeks kind of thing? I mean, is it
Probably every other month, I think.
Yeah.
Right, because every 6 weeks would be.
I could probably go with that. I guess my point to you on time and meetings, which, hey, look, everybody's time is important, but it's all about doing the best thing for the taxpayer, to the citizens of the county, and what's best for St. Mary's County.
And that would be additional oversight, right? More frequent oversight. Obviously, we are looking at these portfolios on a regular basis, but, any action that would be taken would be approved by, obviously, you all in a public meeting. So again, I think there's a balance, like with anything, right? Is monthly necessary?
Probably not.
I don't think so.
A bi-monthly might be a good idea.
Bi-monthly could very well be the solution here. And again, the LoSAP part of the updates would be relatively short in order, given the straightforward nature of the plan. We probably spend more time on the OPEB for obvious reasons. It's a little bit more complex, but I think given the size of the fund now, it puts you in $120 million, that it may be prudent to consider maybe, again, that would mean 2 additional meetings a year.
So it'd be 6 meetings a year instead of 4.
Yes, sir.
I could support that. Yeah.
Others supportive of moving to 6 times a year?
Yes, yes.
Great, thank you. Jody, could you take that under consideration when you present the calendar in December, please?
Yes, thank you.
Thank you. Any other comments on the administrator's report? Hearing none, all those approve?
Aye.
Any opposed? Motion carries. Thank you. Old business, the LoSAP benefits for Bolton Partners financial cost analysis. And Catherine, I believe you'll lead this discussion, please.
Yes, thank you, Dr. Bridget. And you may recall, we've spoken about this at a couple of meetings. The Emergency Services Board presented a variety of requests and recommendations to the commissioners. One that was enacted for calendar year 2020 was a modification for how points were earned because of the pandemic. Another that was recently approved by the commissioners for calendar year 2021 is a modification for point award, again, because of the pandemic. And the modification is through the end of the declared state of emergency. So it would be for the first 6 months of 2021, ending on July 1. The third sort of bucket of requests have to do with calendar year 2022. And if you were to look at the memo that I have included, or that is included, the items that were requested include access to the county health insurance plan, property tax incentives, open access gift cards, free landfill access, and an increase to the benefit awards. During the LoSAP meeting in July, we discussed these and discussed the access to the county health insurance plan. And for a variety of reasons, the board voted to not move that forward. I had a discussion with Mary Claire, and one of the concerns is at what point are volunteers no longer volunteers when you're providing them with benefits, like health insurance.
Now, let me hold you right there at that thought process. What we have had is, it seems like we've had these retirement plans that people have left out, but they've left the money in there because, I'm sorry, I'm drawing a blank on exactly when we did that, but I just remember at one time we talked about how we had people invested in some kind of a plan while they were working for us or something, and then they left us, but they left the money in there because they liked the plan and what it was doing. So I guess where I'm going with this is if you have, I strongly believe is we want to encourage people to come to St. Mary's. We always hear about, the deputy's going to drive to Charles County, the deputy's going to drive to, teacher's going to go to Calvert County. So we want those people in Calvert County that we want, and those people in Charles, we want them to come here. And we want them to come here because we got lower taxes, we got lower property taxes, we got higher quality of life with turf fields and, better schools or whatever but what can we do that is attractive but also without being taken advantage of? That's, I guess, where I think I see us going.
For the LoSAP benefits, you mean?
Yeah.
Right, and that's the needle I think that we have to thread. The health insurance option, from discussions with Mary Claire, seemed very risky.
Could be very high financial impact?
Yes, it could lead to a volunteer saying that they were actually an employee, and that being litigated. And then lastly, it could impact the tax status of the LoSAP plan. Because if all of a sudden these are employees and not volunteers.
So maybe health benefits aren't as attractive as giving free access to the landfill.
Exactly. And so from the discussion in July, the board did not want to pursue further analysis of the health insurance because of those items.
Well, are there other things, I guess, as a commissioner, I would say that you can look at that increase, I use the term quality of life, whether it's access to our Rex and Parks events, whether it's, but also I'd say is audit of who is involved and who isn't involved. So we can understand who is actually on this LoSAP, who's actually responding to these calls, who's going to the rescue squad, or who's going to the firehouse, versus those who went and now have decided to back off. And, it's kind of like an attendance sheet for our boards and our committees where we look at someone who we've appointed to a board, but they haven't been to a meeting. I
Right.
mean, what good are they to the board if they don't show up? Similar to LoSAP, I mean, to EMS and fire.
Right. So the certified lists that the volunteer community presents to the commissioners, that's what I use to determine a number of people.
Who
So-
certifies that list?
So the companies themselves certify the lists, present it to the commissioners, and the commissioners approve it. And that is the group of people that earn the points.
Is it?
And that's done
is it-
around January or so, following the
But
calendar.
is it worth the, I hate to use the term political, that's not a good term. Is it worth the risk of auditing their reports?
I
Is the
don't-
short answer no?
I don't know. So we had an internal auditor a few years ago look at county departments, and he recommended that those lists are audited because this is a
That
large
they
amount of
be
money
audited or that they are audited?
that the county pay to have them audited.
Right.
Was the recommendation a few years ago from this internal auditor. So, the 2020 list for calendar year 2020, there's approximately 1,099 fire and EMS volunteers.
1,100.
And so doing the analysis of these requests, that was what was used.
Are you reading this off of somewhere I should be seeing?
It's this memo right here.
It's
that,
Catherine's memo.
Catherine's memo.
Oh, yeah, I got it. Okay.
Yeah.
So it's in her summary, she's just going down each kind of bullet.
I think I got Catherine's memo. Which one's Catherine's memo? This is from Jeanette.
Right. Here.
Do I have
It
this?
should be in there.
No, if I got it, I got it.
No, that's okay, I have two, I printed one out myself when I was looking at it. So here.
Oh, look, I hate to be like you got it.
You got it. I've got one now. Go ahead and use that one.
I got it, sorry, I didn't see it.
No, it's quite all right.
It was
It's a
underneath the-
lot to
No,
work through.
no, good. Look, I pride myself on reading stuff before I get here. All right, go ahead.
So anyway, one of the items was property tax incentives. And we discussed that last month as well. And Jeanette brought up the fact that there was a focus group in 2018 that looked at property tax incentives for public safety. And those attachments were included. That was presented to the commissioners and no action was taken
Right.
in 2018. And I think largely because of the expense.
Right.
Using that 1,099 number, you know, if we were to provide a property tax incentive of $1,000 a year to all current volunteers, it's about $1 million annually.
Right.
If we were to provide a property tax incentive just to people who are receiving LoSAP benefits, who are eligible to receive LoSAP benefits, it's about $350,000 annually.
Okay, look, I think this is, look, I'm sorry to catch up so late. I really believe this is an important thing to be a quality of life issue for these people volunteering. But I'm going to go back to that audit. You know, if we're going to do something like this, we need to make sure that the people who are getting this 1,099,000 are people who are actually showing up at the places. So that would be my take on it.
Okay.
You know, I'll give it to those who are doing it.
So perhaps that is the response to the request, is that before, you know, these, because of the dollar amount of these requests, before they're further considered, we would like to audit the list.
Right.
I mean, perhaps that's the response.
Would that be an internal audit or external audit?
I think probably external.
External, we would have to hire somebody to do
Yeah,
that.
when you
So
think,
I wonder
Mary-
what that fee would be.
All right, well, that's something to look
We
at.
would have to look into.
Yeah,
Well, that's a good point. We don't want to spend a lot of money doing it, but I'd like to think, if we're talking $1.1 million,
Annually. That's
Annually.
annual.
yeah, that's a lot of money.
yeah,
A.
it is.
But B, we need these, people,
Right.
right? Because I know, I think I told you that, again, this Mako business, Queen Anne County gives a $1,500 tax credit to those people who are doing this
You did.
EMS fire.
Yep.
And the point was, what that lady from Queen Anne said was there was a husband and wife, family of 5, 3 kids, and the wife said, look, I got to go down to the firehouse and put my whatever in. And the husband was like, all right, I got the kids. Well, we're getting $1,500 off the, I mean, we're doing it for the vets, right? We're doing it, we give these kind of credits for veterans.
Yep.
I just think it's something we can work in as long as we can qualify that the people who are receiving it are qualified.
Just to finish the list, gift cards are also not recommended, and I included a quote from an accounting agency, because we would be required to withhold income taxes, social security taxes, and again, the volunteer is now considered an employee or a contractor. Landfill access seemed to be de minimis. So it would not rise to the level of being considered an employee. And then lastly, the Emergency Board requested that we consider increasing their benefits, their monthly benefits, for the people who are currently receiving benefits, and it increases the pool of people currently or that would be eligible to receive benefits. And the board approved Bolton to do an analysis of the estimated expense to the plan for doing that. And their cost analysis is summarized on the chart. And as you can see, it's quite an expense to the plan.
Yeah, it is. That's too much. So tell me, when people become a volunteer, or they go to the landfill and they say, hey, I'm a volunteer, where's your ID?
That would be tricky. I spoke to John Dietrich about that, and he said we would have to really think about how we would manage that.
Well, I guess my thought goes back to this part about whether we use an outside firm or however we do it, again, keeping track of costs, is that once those people are identified as qualified volunteers, it would make sense that they get some kind of a card or something that they can show that says, hey, I passed the muster.
Right, and then it would provide them with that
Access.
benefit.
Or maybe a sticker on their car or something like that.
And again, there's...
Again, it's got to be something that's current, though.
Yeah,
Right.
and there's two sort of types of people. There's those that are actively volunteering, and then there's a smaller group of people who are currently receiving LoSAP benefits. The active volunteers is the 1,000 or so number. The current receiving benefits is about 350.
Well, I say those doing the 350 is still people who did like 20 years, right?
Oh, yes, they have
Almost
to...
like having retirees, they should have some benefit.
Right. So as we analyze this, is it just being, whatever we decide, would it be just offered to those currently eligible to receive benefits, or is it to the whole pool?
Like, I apologize for missing this last night.
So this cost analysis, it included then the health insurance and the increased monthly?
No.
Oh, what does it include?
Just above. So what they requested was that people aged 46 with 30 years of service would be eligible for a monthly benefit.
Oh, so that's all this number, this benefit change. It doesn't include the property tax, just this monthly
Just for the-
change?
Just
Okay.
the change.
Like someone who joined at 16 and hung around for 30 years.
Okay.
Right.
Yeah.
They would not be
This is
eligible.
just too expensive for me.
Right, yep. No, and again, it's just so much material. One of the items that we did, and we presented it last month, and I think it's here for you, this is a comparison of all Maryland counties and what their LoSAP plans look like. One area that I see that we really are less than other counties is this, currently we pay $8 per year for any year worked over the 20. Most counties are paying 10.
Wowee, that's a big deal. It can't be that expensive, is it?
Well, that is, it increases our liability by about 1.3 million is what Bolton estimates. An annual increase in our contribution would be about 150,000.
And so can you describe, Catherine, also in the chart, thank you, it says we are equal to the state on cost of living and virtually no one else is. How does that relate to other counties, the $10 versus cost of living?
There is no other county, and we have it in our code, that we will pay cost of living increases. There's no other county that guarantees that.
And so I guess my point is that you'd have to compare, right, the two, is that other counties aren't offering cost of living, we are.
Right.
And they may be adding the $10, but we have a lesser amount, but we all add the cost of living. So it could be, is it neutral,
Well,
right?
do we have an idea what that cost of living is
Yeah.
costing us?
I don't. I mean, I could certainly,
Kind of back into
Well,
it.
again, I don't want you to have a
right.
big homework assignment.
Another benefit that, from this summary, many people or many counties provide a burial benefit that is more generous than what St. Mary's provides. We provide a $2,500 benefit if it's a line of duty only, and that could be a place that we could look at.
And so is that through a private insurer, or do they do self-insured?
It's through the state, and the state has a program for volunteers.
Okay.
But we could certainly, if the board wanted to, we could certainly look at the cost of expanding that benefit.
So for now, I think the interest of the board is based on the request, and Catherine's memo is to do more research on the property tax incentives and the landfill, free landfill access, particularly perhaps for FY '23, and to make the recommendation for an audit to be conducted.
Right, and the
Moving
cost
forward.
of doing something like that. Because we're talking about, how many people? 1,100 people?
Right.
Well, the audit
Well,
would
but the
be
audit,
company.
right, exactly.
Well, I guess my point gets to be is, if we got, 9 fire companies and 7 rescue squads? Well, whatever. My point gets to be, they have to be doing that internally themselves as far as the actual people.
And they are.
And I guess my thought would be is if we had an auditor involved, they would just be auditing those particular entities versus contacting each individual. Would you agree?
Oh, yes, yes, absolutely.
I mean, it doesn't seem, Marion, don't you think that would be that big of a cost? What's your thought?
Audits are so expensive.
They are.
Oh, man,
They
I
are
know.
just
Look, you ain't
ridiculously
telling.
expensive, no matter how scaled down you think it is, Jeanette, you know.
Right.
It's just, the standards have gotten so difficult that this is not going to be a cheap thing.
There's a great word,
No.
standards. So the key gets to be, it's kind of like an attendance sheet to me. It's like I was saying about these boards that we have. If they're not showing up, they're not worth having on there. So is it that simple, I guess, whoever I'm talking to here? I guess my point being is those audits, you're right, but it depends on, expectations. I use this term, manage expectations. So when we do the audit, is it reasonable to think it's more of like an attendance of,
Well, they would have to come in and evaluate the internal controls related to that attendance. Then they have to evaluate the risk, and based on that, so it could be different for each company,
Right.
depending on what each company has established within their company. So,
still along the line, I don't like to have someone taking advantage of the county
I agree.
and us not wanting to go and see if that's going on because we're worried about the risk or the cost of finding that out. I guess I'm more worried about the perception that we're putting more oversight of them. And they may say, hey, look, we're giving you this list,
I
you
know.
don't trust us? But we're talking these types of benefits, which I think we should do. And that honestly, this risk assessment, what's that term? Risk benefit analysis kind of thing is worth finding out. So if you can do that, Kathy.
So maybe the first step is to get a cost estimate, right, of what the audit would be, and then bring that back to.
But I think first before that is to find out what we want the auditor to do. Because we don't want them.
Well, but I think it's auditing the actual files that come in
The
before.
certification.
So it's the certification process that is submitted, and I think that's in line with what the recommendation was, is to audit those, so the county has their own assessment, for example.
Okay.
Before the approval. So Isn't that an accurate statement?
Yes.
Yeah,
yes.
okay.
So what I'd like to do then with the board's approval is to bring back an estimate of what an audit of the certification list would be, and then perhaps look at an estimate for the burial benefit, if we were to increase that. And then lastly, would you like me to try to assess the cost of living? And what that factor,
See
how
if it
that
equates
factors in.
The additional to the $10.
Versus the $10.
8
You know.
versus 10.
Are you comfortable with those three follow-up items for Catherine?
Yes.
Okay, sounds like you have consensus. Thank you.
Thank you.
Good. Anything else on this item, Catherine?
No, and thank you, and appreciate the patience going through it all.
Good, thank you. It's good discussion by the board. And that wraps up our old business for today. Is there any other agenda items for today? Hearing none, we'll have a motion to adjourn.
So moved.
Is there a second?
Second.
All in favor?
Aye.
Any opposed? Motion carries. Thank you very much.